All right. April 4th here, Friday, 2025. And Nick and I are going to talk a little bit about what's going on in the markets. This is a follow-up to the last two calls where we've talked a little bit about this market volatility, and we've zoned in on the four-step bottoming process. Last couple of days have been pretty volatile here, to say the least. Just a couple of notes, broad-based numbers here year to date. Obviously, we started off the year strong, and we've had a drop off since then, but not from the high necessarily, but from the start of the year. Broad-based S&P 500 down around 14% year to date, not from the high. We're past 15% from the high. The value side's been hit less than the growth side. Value's down around 9%. Growth's down about 17, and our aggregate bond index is actually up for the year, 2.6%. So, Nick, thanks for pulling this up here. A lot of things you can extrapolate from the S&P 500 equity side. This is the 11 sectors of the S&P 500. And one story here I see here is that 2023, 2024, communication services and tech was the darling of the market. Everyone wanted to be in that part of the market. Not too great of a start this year, huh?
No, there's definitely been a rotation into the defensive sectors as a risk off, and the Mag 7 is really leading everything downwards, which the Mag 7 has done a tremendous job of growing those companies in the past, and they're down about 20%, and that was maybe not even taken into consideration today, which April 4th. So those global tech companies, when globalization is at risk, really having a difficult time.
Yeah, so I mean, the negative obviously is that a lot of these tech companies are getting hit pretty hard, which is bringing down a large part of the market cap of the S&P 500. The bright side is this sell-off has been, more of a rotation. Bonds are doing what they should be doing, and some of these boring sectors, consumer staples, utilities, healthcare, these sectors are still positive. So I think that's the positive with the negative. Diversification is working, but a lot of volatility there. Let's go back to our four-step bottoming process here, Nick. I know that the last time we spoke, we were in between step 2 and step 3, but it looks like we're back to step 1, right?
Yeah, we're definitely back to step 1. So in the 4-step process, if you review the last video, we go in more detail, but you always kind of start out with a base of being oversold. The first 10% correction was overdue from just a volatility standpoint. Usually we have a 10% correction every year. Usually we have a 15% correction every 2 years. Pessimism got really, really pessimistic. It was a little bit more orderly the first time. It took 16 days to go down 10%. It's really only taken 2 days to go down 10% in the last 2 here so far. And there's been less rotation into those defensive names. The first time around, there was rotation into international, maybe as a hedge against political uncertainty in the US. But since now we are more concerned about global uncertainty with the tariffs being potentially implemented here, international has kind of fallen as well, and a volatility index have started to spike. So we are definitely back in step 1 of the process. However, pessimism levels are now to a level where this is where it was before, and you can see a little blip up and a little blip down. So when pessimism levels are really high, generally that sets up a potential rallies out of there. And now we are back to near our lows of extreme pessimism, which is even close to where we were in 2020. This generally sets up the base for some type of rallies on the upside. And we can get rallies, and we had rallies even after the first 10% correction. But you don't want to be tricked into those. Generally, the market has to go through a normalization of a bottoming process. So step 2 is rallies, and right now we're still oversold, but given the pessimism levels, I wouldn't be surprised if we start to establish some kind of base, some buyers start to come in terms of bargain hunters and dip buyers.
Yeah, I mean, I definitely had some clients calling today that were ready to, put some cash to work. So you're starting to see that. I don't think it's everyone, right? It's the right type of person. Obviously, it's part of their bigger picture and plan. Pretty interesting chart here on the short term, though, just to show how oversold we are from a short term perspective. So that bottom right hand area, it shows that when the market is oversold like this, that's typically a good thing for returns in the short term, right? Is that what that's saying?
Yeah, I mean, if you could buy just on the bottom here, you'd be really, really good on a long-term basis. So these short-term pessimism readings, when you buy in this zone here, historically, the average annual return since 1994 has been 25%, and since 2006 been 23%. When we're in extreme optimism, when everyone feels great and happy, we get a little complacent. That's generally when returns are negative. In the optimism zone, average annual returns are negative 1.9% since 2006. So everything's essentially on sale from where it was before, but we have to be mindful of the other things going on as well.
Yeah. Yeah, so oversold. The next step would be back to rally, right? So we've hit the extreme pessimism, but we need a 10-to-1 up day. We need folks to come in and start buying securities. We need shorts to start covering. Um, yeah, that definitely didn't see that today. I mean, we did see one thing come out that was positive as far as a rally. I think the interesting thing about this market is that a lot of this is driven on policy. The economy had slowed down a little bit, but it really wasn't the economy that put us in the situation. It's policy. Interesting thing I saw today, a blip across the news was Vietnam, coming to the table saying, "Hey, they're ready to have a conversation." And one of the ways you saw that surface was a pretty big turnaround with Nike stock. It hasn't come back to where it was prior to the tariff conversation, but I think Nike was up about 7 points today. They have about 400,000 employees there, and a large portion of their production that comes out of Vietnam. So, um, you know, what, who's going to negotiate next, right? Like, who's going to make the deals next? When will they be done, and how will that impact the market? Right, that's the big question.
Yeah, so we might be getting a little bit of ahead of ourselves because we're still in the step one. Last time when we recorded this was on what 327, and we thought we were in the retest step where we were kind of near our lows and we had some rallies coming out of there. But what we were looking for is if we do retest the bottoms, which we went back down there, is it going to be with more downside pressure? And we've had more downside pressure and we broke the lows. So essentially, once you get to step three, if you don't hold and you don't retest successfully, you go back to step one. And then hopefully coming out of that is probably getting way ahead of ourselves. But once a base is established and we go through some rallies and a retest, it's usually followed up with widespread buying, really broad conviction of the overall market, just not on a sector basis. And we have different indicators that we look that usually gives us kind of an all clear. And if we don't get this, usually it's followed up with maybe even months later additional weakness. But a lot of our indicators, once we have the conviction here, we usually have a much longer runway in terms of a sustainable rally.
No.
But really, what I think is driving everything right now, for surely is the tariffs. So we had President Trump come in on April 2nd, Liberation Day. And, the market was actually rallying into Liberation Day, maybe coming to peace a little bit with some tariffs. And tariffs were just a lot higher than were expected overall. There was a calculation done by the administration that it was basically each country's charge is equal to half the trade deficit to import value ratio. So it wasn't necessarily how much they tax us, but it was how much they import versus export to us. And so you see, like James mentioned, Vietnam here, because they import a lot less than they export. They're an exporting country. They are basically calculated with a 90% tariff. And so our reciprocal tariff was 45%. So I think really the question here is this so high that it's just a point for negotiation? Like when you start a negotiation, you never start off with your best offer. You give yourself some wiggle room to get in the middle somewhere. And so that's really what we're looking at right now.
There, the market closed today. Yeah, you got to think it's a starting point for negotiation. At least that's historically what this administration has done previously, to try to meet somewhere in a more favorable position. But yeah, I thought you were going to share that algebraic slide that the shared on the website, but I actually showed that to my wife, who's a math teacher, and we were trying to make sense of that. But yeah, this is where those tariff percentages come from. Regardless of where they came from, obviously it's used for negotiation, and we can only hope those negotiations end up being favorable for us in the markets.
Yeah, interesting. When I was watching the press release, or when it was happening, is Trump had come out and said that the reciprocal market expected, and the market started rallying immediately. And then the numbers actually came out, and things just went into a free fall from there. So it was obviously not expected to be at this high level. However, this is fluid, right? Countries are already starting to negotiate. Overall, things can change. We may not end up at this number. So I think the market is pricing in this like worst case scenario. And if it stays at this level, this would be a potential risk for the economy. It's definitely would put pressure on the economy, and make the risk of recession rise pretty considerably. But if we come somewhere to a happy medium, I think we can get through that, and the market kind of comes right back. So this was a little bit more complicated than my last slide, that I did it last time around. But basically, the middle clip is the uncertainty index, the economic policy uncertainty index. And we are as uncertain now as we were in the middle of COVID. And historically, the market has a difficult time when there's uncertainty. Uh, when it's in this uncertainty high zone, the economic performance, like GDP, is actually negative when it's in this uncertain zone. When it's in neutral or certainty low zone, we actually have positive returns on average for economic performance. So it is completely normal that when there is this much uncertainty about global trade, that there is going to be some risk adjustment and some reshapement going on overall.
Yeah, so in layman's terms, if you're a business owner, and there's a lot of uncertainty, you're probably less likely to invest back in your business, maybe to hire more folks or to do some things that could incite growth in your business. You're probably more in that wait and see mode, and I think that's what that's showing here. Uncertainty breeds hesitancy in investing back in the business. Yeah, so stock market corrections are normal. We're actually in a what they would call a severe correction, 0.5x per year. So once every other year, we see an event like we're seeing over the course of this last couple weeks and year. And once every 3 years, we get closer to seeing more of that bear market. But what we're trying to show here is essentially stock market corrections are normal. And at the moment, when you're looking at your portfolio and you're seeing red on the screen, obviously it can be very emotional, very sensitive to see, and it's not a great feeling. But these sorts of things are normal. So anything else you kind of get out of this, Nick?
No, I mean, uncertainty, the market's riddled with uncertainty over the course of time. It's a normal thing. But it always resolves itself to the upside at some point in time. So, we get rewarded as investors on a long-term basis for being able to endure, some market volatility. Otherwise, it would just be easy. So volatility is just a normal part of investing.
Yeah, I think that goes to the next slide here, visual. We've talked about this one in the past quite a few times, but each vertical line there is a calendar year. The blue lines represent end of year calendar, beginning to end of the year returns, whereas the orange represents drawdowns in that given year from the high. Drawdowns are fairly normal. Sometimes they're larger than others. And we're in one of those years where we're probably closer to the median, I would say, or the middle of what we typically see from drawdown. So, we could see more, but these drawdowns are definitely normal in the market. And then I think the flip side to that, and thank you, Chuck, for this slide here, is that we know that by staying invested in the equity markets, we have a chance to have a higher rate of return. So this looks at the last 20 years in the market. If you stayed invested in the S&P 500, you had a 10.4% annualized return. But if you just missed the top 10 days, you missed out on 4% annualized return. We don't have an overlying chart on this, but if you were to extrapolate a 6% rate of return annualized over a 20-year period versus a 10, that's a big difference compounded. So getting out completely can be, really devastating for long-term portfolio returns if you don't get back in at the right time.
Yeah, I think ultimately you go back to, is your plan still sound? Your financial plan, it's made to withstand bear markets, it's made to withstand volatility. And that's where you kind of start from the basis of your investment decisions. Tweaks are better than big moves, because if you make a big move wrong, it can really be a detriment. And then you have to time it right on the way back in. So just wanted to share kind of what we were seeing, trust the plan. And if you would like to talk to one of us, just feel free to reach out to us, and we're happy to go over your plan and go over what our thoughts are about the market. Thank you.
Thanks for your time.